What's going on, everybody? I'm going to do a FTX tutorial today. It'll consist of everything that you will need to understand FTX from the basic foundational level and just to get you started. I'm not going to dive into all the little parts of FTX. You will have to do more research and read some articles on your own, but I will make sure that I cover enough in this video so you can get started on FTX without experiencing any issues and any problems. First thing that I want to point out is FTX has been a little bit more cautious and careful about the non-KYC'd accounts. So if you are starting a FTX account now, unless you are in the allowable countries as per FTX, you will have to make sure that you go through a VPN. And if you go through a VPN, your account may not be verified properly, in which case you may not be able to deposit or withdraw properly either. So be careful about that. Please read the KYC instructions. I do not encourage people to use a VPN, but it is one of the ways to go about using these exchanges and circumvent some of their KYC issues. So please do your own due diligence. Let's get started. First thing you'll notice is ftx.com. This is kind of how the dashboard looks. You'll see all kinds of information at the top here in these bars, different markets. You can see this left-hand panel right here, which opens up different markets, which is the spot market and the futures market. Remember, spot is the actual purchase of the asset. Futures is the speculation of that asset with leverage or some sort of futures dated contract. So let's get started. First things first, I funded the account with $50 here just to experiment with. And FTX has different opportunities to create different sub-accounts. So the strategy and the money from one account does not interfere with the strategy and money with other sub-accounts. For example, if I wanted to go short on the FTX tutorial account, this one right here, I can go short on any product that is available to me. Versus my other accounts right here, I can have a completely different strategy with different collateral, with different amounts of money in these other accounts. One strategy does not have to conflict with the other. One capital from one account does not have to conflict with the other. So this is one of the good things about FTX. Here at the top bar that you could see, you'll see different opportunities to look at your account in detail. You'll see deposits, withdrawals, positions, fills, conversions, and then collateral explainer. All this stuff gives you detail about what exactly is happening in this particular sub account. Now, the fact that I've deposited $50, which is the USD, this USD is actually only local to FTX. This is not a USD that you could send to other exchanges or other DEXs. This can only be moved within FTX, within your sub accounts. If you want to withdraw money from any of these accounts, you have to convert it to actual crypto like Bitcoin or USDT or any other product really. And you can uncheck this right here, which it says hide zero balances. And here are all the different cryptos that are available to you. So I can just hit the convert button right here and convert this to Bitcoin or FTT or Ethereum or Tether. Okay. Now, once you convert your dollars into any of these assets, that will be your spot position. And that spot you can refer to in the non-USD collateral page right here. You can see that if I buy, let's just say Bitcoin spot, it gives me this weighting, meaning the total weight is 0.975. What does that mean? That means that if I buy $100 worth of Bitcoin, $97.50 of that will be usable towards collateral of other levered positions. So here's a perfect example. I have $50 in my account right now. If I go over here to the Bitcoin tab, which shows me different markets within Bitcoin. This is the futures market. This is the move, which is the volatility contract. Same thing here, move volatility contract. This is the spot market. And these are the different tokens and instruments to bet on bull or bearishness or Bitcoin volatility. And so here, what I can do is you could see the collateral right here. $50 is what I have in the account, and $50 is what I get for the collateral for me opening up any long or short position. Remember, the perp contract, like I said before, is the futures contract. Okay, so I can buy Bitcoin here at market with my entire $50 with leverage, or I can use no leverage, which I can do 1x. And then here I can buy $48 with it. And the exchange fees are basically, $2 in this particular case. I can also lever this up to 101x if I would like to. Obviously, there's going to be significant risk with that, but you can use that kind of leverage. In which case, then I can use my $50 and lever that up to almost 5,000. Once again, I do not recommend using leverage or any excess leverage at all. So let's just say we use 10x leverage, right? 10x leverage doesn't necessarily mean you have to use this entire leverage. It just means that that is the amount of leverage that is afforded to you. You can just simply use $50 here, and then you could step it up by buying continuously below. So let's just say I buy $50 worth of Bitcoin at 39,000. That's the limit order. Okay. I can place an order at 39,000. 39,000. And then I can also use another $50 for 39,100. And then I can use another one for 39,200. And I can do this so on and so forth until I've exhausted this 10x leverage. That is basically what this leverage affords to you, okay? And you could go here into open orders and see all the orders that are open, and you can just hit cancel all to make sure you get rid of all your orders. Down here is the screen where it shows you what positions you have open, what open orders are, your trigger orders, your order history, and then your trade history as well. Obviously here you see the order book, right? This is the bid side of the market. This is the ask side of the market. So these are the sellers, these are the buyers, and these are the market trades, which people are selling at market. Orders are either getting triggered or people are manually market buying or market selling. Okay. Down here is where you get information about the contract itself, the volume, the open interest, and then predicted funding rates. This is all information that you'll have to dig into on your own time, but I just want to give you all the basics of where you can find more information. And going through the different order types, I'm going to cover that real quick. So you guys are obviously familiar with market orders, right? Market order is nothing but give me the price that is readily available right now as soon as I submit an order. It may not be the price that you see right here on the ask side. It depends the size of your order. It depends how fast the book is moving. So just because you see the market order here at 39,984, right, doesn't mean that's the price you'll get at the exact second. You never know, in a fraction of a second, that might dump $25 more, or it might spike up $25 or $30 more. It depends on the volatility of the order book itself. Limit orders, however, are static. That means that whatever you place right here, it doesn't get filled until only that particular price point that you've dictated. So in this particular situation, once I've dictated that the limit order I only want at $39,900, this price will not fill unless only at this price is something that someone is willing to sell to me. It's as simple as that. Okay, so if you are a small order or a large order and you want a fixed price and you are unwilling to budge for that price, you just place a limit order. There are other order types here as well. Stop market. This has to more so deal with if you are short in the market and you want to get out of your position, you will stop yourself out with the stop market order. Okay, so here's a perfect example. Let's just say I go short for $50 right now. Okay, we're going to run a test experiment, right? So I'm going to short market right now. So the market order gave me average open price at 39,998. Now, if I don't want to incur a loss higher than, let's just say, $40,001, that's what I'll do. I'll place a stop market order right there. As you can see, my order is placed right there at $40,001. That means if price spikes up beyond $40,001, it has to stop me out. Now, here's something interesting you'll notice. I won't get stopped at exactly $40,001. It might actually shoot up higher, okay? So let's see what exactly I got stopped out at. See, I placed my stop at 40,001, but it actually stopped me out at 40,005. Why is that? Because stop market means stop at the market price. Meaning if price is unable to fill me at the $40,001 marker that I had dictated earlier, get me out at whatever is the most readily available price. That's what a stop market means. Because sometimes what happens is if you've placed a price for 40,001 and price is moving up really aggressively, you may not be able to get out $20, $30, $50 later because the market itself is moving that fast. It doesn't have the ability to fill your order in because other people might have placed orders before you at that particular price point or at higher price points. So the market itself will get you out at whatever is the next available order to you that can fill you. Now, if you want to be really specific with it and you say, you know what, I only want to get out at one specific price, well, then you could do stop limit. And this is where the order itself gets a little bit more complicated and more static. Now, had I done something like the same situation that I did earlier, okay, so let's just do, once again, we're going to do short, right? $50. Okay, we're going to short $50 worth right now. And we're going to say, I want to get out only. So here's the stop limit now. Okay, I want to get out only at $40,001. Same thing now. Okay, so we're going to do that $40,001. So now you can see both my orders are placed here. So even if price shoots well beyond 40,012, it will not get me out of my order until I can get filled at 40,001. Now, the problem with this order is that you risk the idea that the price might shoot up all the way to 40,100, 40,200 before it fills you because it's a limit order. You've basically placed a condition on the market saying, hey, I don't care what happens with the market, only get me out at $40,001. So unless the price fills you at 40,001, it won't execute your order. This is something that you have to be very cautious with because if markets are very volatile and you're very specific with your order prices, you may not be able to get out in time. The same thing happens on the long side as well. If you're placing a long side order, so let's just say you go long now, and you're saying that stop me out down here at 39,950, like way the heck down here. If your order does not get triggered until 39,950, you have the risk of the price dropping further and further without you getting out of the market. Let's take another look at other orders. So I'll do the trailing stop last because that's a little bit more complicated. And we'll do take profit. Now, take profit is sort of similar, right? So we're going to do take profit for the short order that we're in. And we'll say, get me out of my position at 39,933. Let's just do 993 actually. Okay. So we're saying that get me out of my position at 39,993. And now there's my take profit. Okay. Now remember, again, this order is also a market order. That means it may not trigger until prices go lower than that, or possibly spike even higher than that. It will try to get you out at market. Now, once again, here's a perfect example of that stop limit order that we placed. See, I'm still in my position, as you can see, because price is now trading at 40,002. There's my order. You see that green right there? That green means my order is still there. I'm not able to get out of the market, but my limit order is placed. So until price returns back to that area, I'm not out of this trade. So you can see price is spiking higher, but I'm not out of my short trade, as you can see. I'm still not stopped out. So this is one of the risks that you have to contend with is if you want to get out at a particular point, you must risk the market going higher, or let's just say, lower, vice versa, depending on if you're long or short. And then you will only get out at that particular price. See, there you go. Now my order has triggered. Boom. If you now look at trade history, guess what? I got to get out at 40,001 exactly. So I had to risk the market spiking up well beyond my stop, but then it came back, eventually returned and said, hey, we have an order to get out at 40,001. Let's get this person out of the position. That's exactly what happened. Okay. So you've now seen two different orders play out. Let's go quickly to the long side and do another order. So now we're going to go long. Okay. So in this particular situation, we're long now. We're long at 40,006. So here, what we're going to do is we're going to do trailing stop. Okay. Trailing stop here, because we're long, you have to do a trailing stop at negative prices. Why? Because the prices are way the heck up here around 40,000. So that means that every, let's just say negative $10, whoops, negative $10, move my stop up. Okay, so we're going to do trailing stop. What does that mean? That means that wherever I just placed the order, which you could see right here at $4,003, it's saying that every time price keeps going up, make sure you keep raising this stop price by $10 below whatever the price is trading at. Okay, so right now, if the price is trading at, as you can see, $40,003, it's trying to trigger the price at $39,994. Okay, so that means that my trailing stop is at $39,994, and I'm in a long. If price gets to $39,994, I will get out of the market at that particular price. Well, actually, this is also a market order. So same thing applies earlier, which is it may not trigger at $39,994. It will try to sell at market once $39,994 gets triggered. So this could be easily $39,990 or $39,980. Okay, so this trailing stop just means that if price keeps going on up and you want to make sure you secure your profit, this price should actually keep moving up by itself, because I've created the trail value at $10. I can make this anything. I can make this $2 or $5 or $25 or $100. It depends on how close you want to move your stop up every time the price moves. Okay, so let's just see how this price gets us in or out of that position. This should have triggered now. So we should have gotten out of our position. See, $39,994 was our trigger. Guess what? We're no longer in the position. Let's go to trade history. Where did I get out? $39,993. So as you can see, I was slipped by $1, meaning the price tried to get me out at $39,994, but I got out at $39,993. Not bad, but still, you can see when a market is very volatile, you'll see a lot of slippy movements like this. You'll see your stop get blown out by $10 or $15 unless you use those limit orders that I had talked about earlier. Okay, so now you have a grasp of the basics of understanding these markets, right? Understanding the different order types. You can, once again, do many different things in FTX, right? But for the basics of purposes of trading, you can do spot. Okay, so let's just say you don't want to trade futures. You just want to do spot. Well, you could do Bitcoin USD spot, and I can just do buy at market with my entire spot position. Right now I have $48. I'll just say, you know what? I'll buy spot right now. Guess what? Now I have $48 worth of Bitcoin. Okay. What can I do with that $48? Well, I can sit just in my spot position in the market, or I can do this. I can go back to the futures market. And now you see it says, hey, I have free collateral of $47.43, meaning the Bitcoin spot that I just bought, I can use that same collateral to lever up in the market and use that basically as money against my futures or my leverage positions. I can do that not only for Bitcoin, but I can do that for Ethereum, or I can do that for any of these futures contracts right here. I can do that for FTM if I want to. I can do it for Matic if I want to, any of these, okay? That's the great thing about FTX, which is that you can use your collateral of Bitcoin or whatever spot position that you have for other parts of the market. Okay, that means that you are basically levering up in two different ways, because you're saying, hey, I want to buy spot Bitcoin. And if prices are going up in Bitcoin, great. And then at the same time, I can say, you know what, I also want to be levered long Ethereum, right? So let's just say if prices are going up for Ethereum, like I said, I'm going long in Ethereum right now. Okay, so let's just go long in Ethereum. So prices are going up in ETH, and I'm making money in Ethereum long contract, and I'm making money in Bitcoin spot. So I'm making money two different ways. But this doesn't work properly when prices are going down, because guess what? My Bitcoin prices, my Bitcoin spot prices are going down, and then my Ethereum spot prices are also going down. So what happens in this situation is what we call negative convexity. What that means is it's just a fancy word of you're not going to have enough collateral to be able to cover the losses of your leverage position. Because if your spot Bitcoin prices are going down, or spot whatever asset that you hold is going down, well, this liquidation price gets tighter and tighter, and you'll actually see this drop slowly but surely. So at the same time, you'll also see your collateral being reflected. See that right there? My collateral was $47, but now it's $42. Why is that? Well, because first of all, I took a long position, and at the same time, the Bitcoin that I bought, let's just say 5 minutes ago or 10 minutes ago, at 40,000 is now at 39,975. So it's actually dropped in value. Okay, so my collateral has gone down in value. So how does one play these markets in a more substantiated, risk managed way? Well, what you could do is you could say, you know what, I want to take out this long position, and instead, let me close this out. And instead, I will hedge it, and I'll say, let me just go short Ethereum, okay? And this will be a hedge in the market because I have $50 of Bitcoin spot, and now I have $50 of Ethereum spot. So depending on where the market goes, up or down, one of these positions you can cut, okay? You can, if the market keeps going down, you can say, you know what, I'm going to stick with my Ethereum short position, and I'm going to sell my Bitcoin collateral, my Bitcoin spot. If the market keeps going up, you could say, you know what, I don't like where the market is going. I'm going to sell my short position, and I'm going to keep my Bitcoin spot position. Okay, this is how you can put on hedges in the market. All right, because now you don't really have to pick a direction in the market. You just kind of see if the market breaks above X level, you stay long. If the market breaks below X level, you stay short. That is how you can properly utilize hedges. So I've talked about different order types. I've talked about different usages of collateral. Last thing I'll show you is not being able to use your collateral, okay? And this goes with what FTX has in their non-USD collateral here, right here on this page, okay? What this means is you saw the ability for us to use Bitcoin spot as collateral. But what if you were not wanting a position in the market that doesn't really have collateral, or you bought into a spot position that does not give you the ability to use your collateral for other purposes? So let me show you. So what we're gonna do is we're gonna sell our Bitcoin at market here. You can kind of see prices of Bitcoin spiking right now. So good thing is it's spiking, it's great. We get to sell at a higher price, right? Fantastic. What we're going to do now is we're going to go to other assets in the market here. And one asset that I know of that doesn't have the ability to use as collateral is Rune. It's probably because, Rune itself does not have that much liquidity. Maybe FTX thinks Rune is risky. I don't really know why they don't allow collateral to be used on this, but here, watch this. So I'm going to buy Rune spot. Okay. Now, guess what? If I go here to the futures contract and I say, let me go back to the Bitcoin perp contract, which is a futures contract. Okay. Oh, I'm sorry. I guess, let me see here. I guess Rune now does have collateral. Okay. Before it actually did not. So I'm not quite sure what happened, but let's go to something else. Okay. Let me show you exactly what I'm talking about. So let's just sell Rune real quick. back in the day, Rune actually did not have usage of collateral. It actually did not let you sort of use Rune itself to collateralize for other positions. Let me see another asset that does not have, let's see. So this is where they'll show you all the things that have weight against collateral. So let's just see if Gala does. Gala is another one. I'm not quite sure if it does have collateral. So you have to go on this page and see, does Gala show up on this page? See, Gala is not showing up here, right? If Gala is not showing up here, that means that once you buy spot Gala, so I'm going to buy spot Gala, okay? Once you buy spot Gala, it means that you are not going to be able to use it for other perp contracts. See that right there? Now my collateral, if you look right here in the wallet, I now have Gala spot, which is $48 worth, but I cannot use that to lever up in other parts of the market. I can't use it for Bitcoin perp positions. I can't use that for Luna perp positions. I can't use it for anything other than just holding on to my spot. Okay. Why is that useful? Well, sometimes people just don't want to use their spot positions for leverage. Sometimes you're just not able to. It's just bad luck that this particular altcoin is not going to allow you to use it as collateral for leverage. It's just, it is what it is, right? So point is, you have to pay attention to this particular page and understand what exactly is a altcoin or particular asset that can or cannot be used to use as collateral for leverage, okay? There's obviously many other things that I can discuss, but for today's purposes of keeping this short and simple and getting you to the basics of understanding FTX, this is all that matters, okay? You will also see maybe one thing in the market that's, I don't know, kind of strange, which will make you panic a little bit. Sometimes your US dollar might go into negative, and that will probably be because you were stopped out of a position or something went wrong. So let me show you all that real quick before we end this session. So we're going to sell our Gala, okay? And what we're going to do is we're going to buy, let's just say Bitcoin spot. All right, so check this out. So we're going to buy Bitcoin spot again, okay? I'm just doing this for demonstration purposes. And then what I'm going to do is I'm going to go here and I'm just going to short the market, okay? I obviously know this is not good because prices are going up. So I'm now short, right? I'm now short, and guess what? Now I have probably negative P&L. Let me short more so I can show you guys, demonstrate how much that negative P&L can impact me. Okay, of course it goes into positive. The one time I'm trying to show you guys I'm actually losing money in this particular trade, it actually goes positive. But here, let's just hope that the prices spike up further so I can show y'all what happens here. You'll see my collateral right here fluctuate, right? Right now I have $1.50 because that trade right now, the leverage trade is in positive. But this is going to fluctuate because by the time my short trade goes into negative territory, this will start turning negative as well, okay? And that just simply means that, hey, you are in a trade that's in a losing position. That's all the market is saying, right? Okay, well, I guess I shorted the freaking nearby top. Let me close this out and let me just see if I can go long and see if I can show y'all negative position in the market. Oops, 250. Okay, let's just see if I go long now. So I'm long now. So hopefully if the prices keep going down, what that will do is it will take show my account. So as you can see, now my collateral is dropping, right? It went from 150 or 160 down to 140. Now it's climbing back up, but hopefully sooner rather than later, this is going to start flipping negative. And once that starts flipping negative, what that will do is that it will reflect right here and show you negative prices. You don't need to panic because all this is saying is, hey, you're in a position that has yielded you negative collateral value right here in US dollar. And once you have a significant chunk of negative collateral value, what FTX, the exchange, will do is they'll see, hey, does this person have enough money to pay us back for the amount of negative collateral that he has? If not, they will start selling your spot positions. Okay. The BTC spot that you have, they'll start selling it. If you have other spot positions in the market, they'll start selling that. Again, this does not interfere with other sub accounts. It'll only be in this particular sub account. So you could see this collateral value going negative slowly, further and further, right? So this is indicative of the fact that, I'm in a bad position in the market. And even if I close this out and I have negative collateral, if my spot position in the market against the collateral keeps going down, so let's just say I have $48 of Bitcoin, but then I have $45 of negative US dollar. Well, once this 48 becomes 45, FTX will sell everything because they'll say, hey, wait a second, this guy doesn't have enough money to cover his negative collateral. Let's sell everything and cover our losses from this account. That's what they will do. You have to have, I think, 80 or 90% of the total negative collateral value. And if that's not the case, then FTX will start maybe charging interest or just start selling your spot position. Okay. So anyway, I think I've demonstrated enough of how to use FTX. I've shown y'all the order types. You can create different sub accounts right here. All right. Hopefully this information was useful. I'm just going to close this out. And that's it. That's all I got for y'all. Thank you so much for watching. And if you do like this video, hit the thumbs up. Okay. Cheers.